Welcome to Trading Nation. I'm Eric Chemi. Today, let's take a look at the markets after what's been a wild week for stocks. We've got Stacey Gilbert from Susquehanna and Mark Tepper's here from Strategic Wealth Partners, both weighing in. Stacey, let's start with you. We saw the VIX surge as stocks saw the worst week in years. What are the options market telling you right now?
Yeah, the options market is certainly pricing in increased volatility going forward. So let's just kind of put this into some number terms. If I were to look at where we were in the beginning of January, a price of, let's call it 1.5 to 1.7% in the S&P 500 to see on a close-to-close basis, market was saying something like that would probably happen maybe twice a year. That type of volatility is now being priced in to be realized twice a week. So that's where we can look at in terms of magnitudes of moves using options. Options are really saying what was supposed to be somewhat of an outlier event is now going to be something that we're expected to see a lot more often. So there's a significant amount of volatility being priced into the market. What happens when you increase volatility? It increases the price of options. So if we were to look at what the price is, let's say to hedge a portfolio, the S&P 500 portfolio, and you're looking at maybe a 5% out of the money put. A lot of people refer to this as your 95% put. It's going to basically kick in when the market's down 5%. That price has gone up by almost 3.5 times as much since the beginning of the year. It cost you somewhere maybe around $20 at the beginning of the year, and now you're looking closer to $75. Even if you were to look at it from a spread perspective, where you buy one option and you try to offset that cost by selling another further out of the money option, that price, if we were to look at, let's say, the 2.5% out of the money put versus the 10% out of the money put, that's almost doubled during this time frame. So that's really what the markets are pricing in here. There's increased risk. There's increased intraday movement. You know, it's kind of an interesting random stat, and this is where my nerd math comes out. If we look at what the market actually did this week, we saw a move on what the market would expect to happen, a 5.6 standard deviation move, meaning that is just almost never going to happen. The markets weren't even prepared for this much volatility, which I think is what caught a lot of people off guard.
Mark, you heard what Stacey had to say there, something from twice a year, now twice a week, twice a month, whatever it was there, but just frequency, volatility, it's picking up. Where does this end, or are we just immediately into a new normal, and is this just what it's going to be the rest of the year?
I think we're entering a new normal, but what investors need to do is just stay calm. I mean, corrections like this typically happen every 13 months or so. The problem is investors have been spoiled with the S&P basically setting a new record high every day in 2017. The fundamentals haven't changed. This sell-off looks completely technical in nature. The VIX soared by roughly 4 times more on Monday than it should have, based solely on the decline in stock prices. So a spike in volatility caused the stock market plunge, not the other way around. And when you look at the muted reaction of other risk gauges like junk bonds and emerging market stocks, it's reasonable to believe that this is just a normal correction. So we believe stocks are going to be higher in 12 months. We still expect the S&P to surpass 3,000 before the next recession. So the proper strategy here is to buy the dip. People seem to be worried about rising interest rates, but here's the deal. Stock prices and interest rates move in the same direction until the 10-year Treasury yield hits about 5%. Then they invert. And we're under 3% right now. So rising rates aren't a bad thing. In fact, it's a sign that the economy is actually doing really well. So right now is the best time for investors to be repositioning their portfolios because the bull market isn't over. This is the time to find those stocks that you've always wanted to own. Maybe they're down 5, 10, 20% from their highs, and add them to your portfolio.
All right, Mark, good insights there. Nice jacket too. Stacey, thanks for being on here with us. That does it here for us on Trading Nation. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.